No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. All right, today is going to be about how to make some money. All right, so we want you to pay attention. One of the things that I've brought with me today, a lot of research that I share with clients when they come into the office, and I touch on this here and there on the show, but today I'm going to try to really bring some things home for you when it comes to investing. All right, in particular of how to get more money from your money. This is a really difficult time for that with the Federal Reserve policies, or monetary policies, if you will. Right now, we're looking at very, very low returns, right? I mean, this is one of the things. If you were investing in CDs as an example, you're getting less than maybe 1% depending on how long your CD is. Even a 10-year CD. 10-year CD rates, you're looking at around 2 to 2.25% depending on the bank. All right? 10-year treasuries ranging around that same 2 to 2.3%, and you're tying your money up for 10 years. Right, without having a penalty to take it out, or with treasuries maybe not getting as much money as interest rates rise. So how can you make money in today's market? You know, one of the things that we're going to look at as well, if you're familiar with the Standard & Poor's 500 index, so when you watch the news, they're talking about this is what the Dow Jones did, the 30 largest blue chip companies, and in the S&P 500 index, this is the 500 largest companies in the United States. They make up 70% of the equity in the stock market, all right? So out of thousands of companies, these 500 make up 70% of the money that's in the stock market. Here's another interesting fact about the S&P 500 index. That index outperforms 96% of equity mutual funds out there. All right? So if you're investing in these in actively managed equity mutual funds in particular, you're getting a lot less return than what you could if you just had an index fund like the S&P. Now here's another interesting, I'm going to show you a slide from, this is through Dalbar, which is an independent research group on investors. All right, now this is slide number 1, Dalbar Research Study Results. And as you can see here, this is over the last 30 years. The S&P 500 index, that top line, gave a return of 11% per year over the last 30 years. Now you compare that to the average investor, and they only got 3.7% over that same period. All right? That's the kind of thing that you would have been just better to buy the index. So what happens? What causes this? Well, we're going to show you another slide. That's 30 years, and you're thinking, well, 30 years. Well, let's look at a little more recent history. How about the last 15 years? So let's take a look at slide number 2 here. The long-term annualized returns of the S&P 500 index, all right, versus the average equity fund investor. So look at that. The green bars are that's the S&P 500 index return. As you can see, starting from 2000 all the way through 2014, the red bar, which is the average, what the average investor got, never gets close to what the S&P 500 index brought over that same period. Okay, less than half, and in some instances you can see it's a fraction even. So how can what causes this? Let's take a look on the average investor. All right, one of the things, there's some things that cause it, and on this one of those things, we're going to go to slide number 4. All right, and on slide number 4, excuse me, let's go to slide number 5. Sorry, I'll get these in order here. Slide number 5. And what I'm going to show you here is why market timing. This is one of the things the average investor, they get nervous, right? What's going on right now? People are nervous. What's going on with the market? Is it going to go, about to go really down into a bear market? We've had a very dicey year, right? It's down 6 to 8%. That's the S&P. Again, what did I just show you with the average investor? They did even probably less than that. If you look at the S&P over the last 15 years, we saw it way outperform the average investor, and I'm going to bring that into perspective here in a moment. But here's some reasons why that can happen. One, market timing doesn't work. The average investor tends to try to time the market. They get scared when things go bad, and they maybe pull back from the market and how they're investing, or they get really, then the market starts going up and they jump in. So what they're doing is the opposite of what they're supposed to, which is they're buying high and selling low. Okay, that's one. Number two, they may not be properly invested. All right, that's another big part of investing. I just showed you the S&P 500 index, so we can get rid of the slides for a moment. And let me explain something about the S&P and about properly investing. The S&P 500 index, if someone's just starting out and they got many years, 20, 30 more years that they're going to be saving for retirement, and they just have a little bit of money, an S&P 500 index fund may be an excellent way to get started. And then as you build up money, you can layer in other things to that will help reduce volatility, which is what we're going to talk about also today, how you can reduce the volatility of the S&P, because that's one of the downsides with the S&P. You can have periods, all right, where it can do exceptionally well, as we've seen since 2009, as we saw in the period from about the end of 2003 through the end of 2007. Those were all strong periods. Of course, the 1980s and 90s were extremely strong periods for the S&P 500 index, with double-digit returns average per year. All right, I remember back in the 90s when we would sit down and do planning, we were so indoctrinated at that time with the information that we were receiving. We were thinking 10 or 12% was a safe number for a moderate portfolio. And then, of course, then the new century hits. 2000 through 2009, basically a losing decade. And even over the last 15 years, the S&P 500 index has only returned about 3% a year over the last 15 years on average. Now that's not counting year-to-date 2015, of course, when the market has come down, so it's actually off of that, which means basically if you add in for inflation over the last 15 years, if you invested in the S&P, or if you just had an S&P 500 index fund as an example, you'd be basically at about a break even. Okay, your money wouldn't have really grown when you adjust for inflation. And if you're spending money, that could be a problem. And if you're paying taxes on that money because it's in a retirement account and you're pulling it out to spend money, that could be a really big problem, right? So and of course the spending itself, you're reducing down. So if it's just barely keeping up with inflation and you're starting to spend it down and having to pay taxes and all those things, it's going to get you behind the 8 ball real quick. Now here's the other part. What did I just say? The S&P, we just showed you, outperforms the average equity fund investor, the average investor in the marketplace. And not everybody goes 100% stocks. So if you blend even with stocks and bonds, you see that the result is about the same. In fact, Dow Bar, again, when you look at the average for the asset allocation funds, let's say, or for the composite fund investor, meaning someone that has both stocks and bonds, still received less than half of basically what the S&P did over the same period. So now imagine then, that means over the last 15 years, the average investor, if they earned less than half, they maybe got 1 to 1.5% on average if they stayed in the market through that whole period. All right, that's got to be very frustrating. Okay, and then to put on top of that, that's through 2014. Now let's throw in 2015 and you're seeing the accounts go down. Okay, so there is a better way though. Over that same period, over the last 15 years, all right, the portfolios, there are portfolios, for instance, that did 5 to 7%, okay, over the same period that the S&P. In other words, we're talking about you could have invested over using asset allocation and diversification, some principles I'm going to talk about, and I'm going to show you how to put these together in a portfolio this morning that would have doubled your return compared to the S&P 500 index over that same 15-year period. Wow. Okay, now that's what we're talking about, right? How to make money on our money, how to make sure our money's working as hard, at least as hard for us as we did to get it, right? So we're going to get into these when we come back. We're going to take a break. When I come back, I'm going to show you how this investing thing works, how some of these myths out there set us up for failure, and how you can, in fact, learn the truth this morning and set yourself up for success. All right, so join us here. We're going to be right back on the Retirement Report.